We've seen Morgan Stanley come out and talk about a 60-20-20 portfolio last week. Where are you on gold and gold related ownership? Should people have a couple of percent, 10%, 20%?
50%.
50?
50.
And can you give just a concise answer as to why you take that position? Welcome back to Metals and Miners. I'm your host, Gary Bohm. Today, we're diving into the volatile world of geopolitics, critical metals and mining, and global market strategies. I'm thrilled to introduce Simon Hunt, the founder of Simon Hunt Strategic Services, who will join us to discuss all of these topics in depth. Simon, it's an honor to have you back on Metals and Miners. Welcome to the show.
Oh, the honor is all mine. Thank you for having me.
Thank you, Simon. Okay, so you've been around for multiple commodities and geopolitical cycles in your career. With each cycle, there comes uncertainty, unease, confusion, and mixed signals. And this one isn't starting out any different. What do you hope for those tuning into this conversation today will walk away with after listening to our discussion?
I think the primary message is caution. I've just actually read the World Economic Forum's survey of chief economists across all their member companies, and I think the words really sum up what the real situation is, rather than what's been expounded by so many investment banks. So the 3 points came out of the 28-page report, to me anyway. The global economy is undergoing a period of profound transformation, marked by persistent short-term disruption and heightened uncertainty, as well as long-term structural change. The second point, the global economy has shown resilience in the face of major turbulence this year, but the outlook remains weak and risks are firmly skewed to the downside. And finally, the global economy is undergoing one of its most turbulent periods in decades, with a convergence of shocks and structural shifts rewriting the rules of growth, trade, and governance. Evidence of change is everywhere. And I think those 3 points really sum up the big picture that confronts the world today.
Yeah, and I appreciate the way you just articulated that. So you recently wrote that, quote unquote, my perspective centers on the geopolitical realignments and cycles that are reshaping the global order. The risks ahead are political, they're financial, and they're security driven. And they point to the end of the current monetary era. As the world shifts from a US-led system towards a multipolar one, resilience and protection become essential. It sounds a little similar to what you just read there. Would you expand on what you wrote there for us?
Sorry, did I write that?
Yes, you did.
Oh, hooray, it's very good.
Okay, good job. You approve of this message?
I approved of it, yes.
Well, anyway, so you're talking about these risks, political, financial, security-driven risks, that they're pointing to the current and the current monetary era coming to an end, and that the world is shifting from this U.S.-led system to a multipolar one. Would you expand on that for us?
Where do I start? What I think the big trend that is happening in which I wrote in a piece that went out Sunday night. What is at stake for America is their dollar's hegemony, and thus the country's ability to dominate the world. For the EU, it is their survival as a regional unit. For Russia, it is the continuation of their own sovereignty that has existed since 908 AD, with their adoption of Christianity. For China, having suffered from 100 years of opium wars and Japanese occupation, will want to grow peacefully without external interference. And for India to continue to prosper as an independent nation. So what does this all mean? It means that a world centered around China, Russia, and now India wants a unipolar world, whereas America and her allies want to continue to dominate the world. The actions which are being taken by America and her allies, whether in the Ukraine or the Middle East, are part of this big jigsaw puzzle. What do I see happening geopolitically? I think it's very likely that the EU leaders, being in such a desperate situation with their own situation, whether it be electorate discontent with the power of Brussels, the huge debt problems between governments and the private sector, and immigration, they need a distraction, and wars are always that distraction. Where does America stand in this? That's a difficult question to answer, particularly as some, such as the Daily Telegraph, have suggested that King Charles helped to persuade Trump to continue a support of NATO's war against Russia. How will he do that? Probably by the sale of military equipment to NATO, paid for by the EU. But how will they pay for it? They'll have to raise money, which they probably can do. But if you look at the extent of the false flag operations that either America or the EU, or both together, have been mounting against Russia in recent weeks, and if you look at the anti-media campaign against Russia that has been mounting in recent weeks, it's leading to a high risk that the war in Ukraine will escalate, with Europe in some form or another, probably not with troops on the ground, will be there to support Ukraine. There is another very big part of this jigsaw puzzle, and that is that the elites in both America and Europe want Russia to stay bogged down in Ukraine so that they cannot come to the assistance of these groups' major objective, which is to create, by destruction, a regime change in Iran. So you've got Europe and the Middle East actually joined together. The problem is that Iran has received large-scale military equipment, satellite equipment, offensive and defensive missiles from both Russia and China. And they have been making preparations, knowing that an attack is coming. So I think
I don't mean to interrupt here, but I think it's interesting, Simon, because France has instructed its hospitals to prepare for a wave of mass casualties sometime around the first quarter of 26. We saw Russian drones violate Polish airspace last month. We see, which is a direct.
Well, hold on.
I'm saying that's what was reported. That's what was reported. I agree with where you're going with that. But anyway, President Trump recently posted online that he's ready for more sanctions on Russia and 50 to 100% sanctions on China by all of NATO if they're willing to do it. My point is, to everything you're saying, it feels like the war drums are beating louder and louder and louder than they have in decades. So it seems like what you're saying and what I'm feeling and what others are feeling, it's confirming that there is some likely kinetic conflict that's coming. I can see the scenario that you're laying out here. I think a question that is on a lot of people's minds is, based on these geopolitical tensions and what is likely to come, how will they impact the critical metals that are needed to keep progress marching forward?
Yeah, before I answer that, I think that it is very likely that the attack on Iran will come sooner than late in the first quarter of next year. I think Netanyahu is rather like a caged lion. Domestically, he is running into a lot of trouble. And internationally, both in America and elsewhere, he is also beginning to be trapped. And I think these two forces will encourage an attack jointly with America to be much sooner than, say, by the middle of next year. I think it's likely to be before the end of this year, if not early next year. So your question is, what does this mean for critical minerals?
Yes.
How do you define critical minerals?
Well, critical metals. So, here we have, you take a list of metals that people are paying attention to, from copper to silver to gold to lithium, et cetera. I mean, we can go on down the list. These are things that are intended to keep technology progress, grid, AI, robotics, all that type of progress that has everybody captivated right now. Okay. And their eyes are over there, but we're running into some shortfalls with silver. There's some issues in copper, as things become more bifurcated because of war, that puts more strain on things. So, what's your viewpoint there?
Let's start with gold. The real rise in gold is less to do with inflation and much more political and geopolitical tensions. So it's quite likely that we could have a short-term correction in the price of gold, but it's only short-term. The gold price is bound to continue rising. I'm not clever enough to suggest how high, but just using a very simple example, we have the dollar index, DXY, falling by 50% by 2028. So in dollar terms, you could say that gold will be double the price today. Silver, because of its growing applications in technology, you could see a higher rise, but I'm not a silver expert. Copper and other base metals are aligned much more with the macroeconomic situation. And on recent data, official data, plus our own data from China, which we know to be secure, actually, the global copper market was in surplus in round numbers of 750,000 tons in Q1, and we are expecting a deficit in the second quarter of around 500,000 tons. So in reality, the copper market this year is in surplus. And the way that the economy is likely to progress for the rest of this year, growth will slow down, if not go into recession. Then we expect copper to have a significant fall in price, hitting a bottom around the middle of next year. And I'd say that's probably the same for all the base metals. What one has also got to take into account is not just that technology creates new markets for copper, like data centers, A1, et cetera, but that technology substitutes copper. You're seeing it in EVs. This has been an ongoing process of aluminium replacing copper wiring in EVs. But the new trend is for the voltage architecture to go up to 48 volts, which means thinner wiring, thinner connectors, more substitution. And in data centers, what you're seeing is an increasing use of fiber optics, not only into the wiring up to the rackets, but within them because of bandwidth. So where speed is required is fiber optics and not copper. So all I'm saying is we're looking at the future. We have to, not just the next 1 year, but beyond that, we have to take into account what's happening within copper itself and not just extrapolating, which most people seem to do, the future of data centers, EVs, et cetera. But I have an even bigger concern, and that is that in such a fractured world that we have at the moment, it's all very well to say by 2035 or 2040, copper consumption will be X plus Y. You've got to get from here to there. And from here to there, it's not going to be a straight line. It's going to be very volatile with violent swings, both up and down, which means the recession, and even from 2028 onwards, one can say depression. The other point I would make is that if these wars break out within the next 12 months, given the fragility of the financial system in the Western world, instead of having an inflation-driven takeoff from the middle of next year up to 2028, we could sink straight into it around the middle of next year. So all I'm saying is finding the path to future copper consumption is going to be very complex and is not going to be driven by an extrapolation of recent history, but of these violent moves that we are going to see depending on outside forces.
Well, that is very well said and in depth, and I think it's the nuance should not be missed by those who are listening. Let's shift over
But if I could just add another point, what it also means is that any correction in the gold price is an immediate buying opportunity.
Okay. All right, let's shift over to gold, but also to the Federal Reserve. When governments debase their currencies, gold preserves purchasing power. That has been a pattern that is consistent across cultures and time. Today's setup is even more compelling than previous cycles because the scale of debasement is unprecedented. The alternatives to the dollar, they're limited, and the mathematical impossibility of the debt trajectory leaves policymakers with really no viable options except more money printing. Is that what you're expecting at some point in the near future? More money printing?
I think that's an inevitable consequence of what the current government in America is trying to do. Whether we have war or whether we just have an escalation of conflicts and continued economic progress, it's the same answer. It's going to be money printing. There are, as you know better than I do, there are all these stories going around about, oh, we will introduce stable coins and link a stable coin to a treasury note. Well, all that's doing is introducing another form of debt instrument. And then you had the famous words of President Putin's economic advisor, basically saying the dollar will be devalued in the crypto clouds. It's paper, but what China and the BRICS are doing is back to basics. And the idea of what they will do began actually in 2010, when Russia and China both decided to trade between each other in their own currencies. Then, and as of now, Russia runs a big trade surplus with China. How is that covered? It's covered by the PBOC transferring to a special vault the value of that trade surplus. So where does this lead us to? What it means now is that the Shanghai Gold Exchange is building vaults in BRICS member countries. One has been built in Hong Kong, which has much bigger significance. There is a second, either has been built or is near completion in Saudi Arabia. So that at the moment, Saudi has a trade surplus with China of about $20 billion. So that will be covered by the equivalent gold in that vault in Saudi Arabia, not in Shanghai.
Which makes sense, because where would
Of
everybody
course.
like to keep
Yeah.
their gold? Not
Yeah.
everybody's going to want to put it in China, but if they can keep it in their close to their, home territory,
Absolutely.
it
They've
makes the
got
system
control of
much,
it.
yeah, it makes
Yeah.
the system much more
Yeah.
palatable.
So we'll see other gold vaults being built in other BRICS member countries. So what we're seeing is the reintroduction of gold into the monetary system within a large part of the world. Now, China is not only going to use gold as a secure collateral, but it is going to use gold as a financing instrument. And China will do this by moving gold from its current tier 1 status towards recognizing gold as a high-quality liquid asset. If, or at least when, this move takes place, it would unlock gold from being a secure asset for collateral use into a financing instrument for trade and the repo market. Now, obviously, the BIS and Western central banks will be fighting to stop that happening. But China now has the collateral and size in order to do what it wants to do, which will be backed entirely by BRICS. Mm-hmm. So it is another way of gold coming back into the monetary system against the wishes of America and her allies. However, I had a very good friend who was a senior director in a major international financial organization in Washington. Unfortunately, he's passed away. But I remember him, and this is about a decade ago, I remember him saying, and I'm paraphrasing, "Simon, wait until you see $2 being introduced, $1 for domestic consumption, which will be backed by gold, and the other for external usage, which will be allowed to find its own level, which on our work is a 50% depreciation from today's level." So who knows? I'm just throwing that out as an interesting observation. That might happen.
Yeah, so there's definitely a paradigm shift taking place in the global monetary order. That is unquestioned. The BRICS are leading the charge to make this change. They're making significant headway. And I think the ripple effects are being felt already, and that is no question. Another paradigm shift is on the mining side. So for the last several decades, mining has been put out to pasture by the Western leaders in favor, because, it was a dirty, disgusting, anti-ESG type operational effort. And instead, the focus has been on high tech, crypto, and some other things. Well, the US and its allies, I think they're waking up that their entire technological and military superiority depends on the materials that are, for the most part, controlled by their primary geopolitical rivals, China and Russia. So with the new administration, the response has been already to embark on a massive government-backed effort to build domestic mining and processing capacity at any cost. In fact, this Secretary of Interior, Doug Burgum, he was answering a question last week, and in response to the question that he was asked, he said the mantra used to be drill, baby, drill, but now it's mine, baby, mine. That's the new mantra. What are your thoughts on this paradigm shift that is taking place with mining coming back to the forefront?
That is a very, very important question. How do I answer it? First of all, sometime down the road, if America has raised a sovereign wealth fund, then you will return to the years of the 1960s and 70s, when the GSA was physically buying metals like copper and created a huge stockpile, which has all been sold off. A lot of that purchasing was not on the physical market, but it was on developing infrastructure where payment was not made in dollars or currencies, but in metals. I mean, I have the personal example through my father of the development, the financing of the long-distance transmission line from northern Rhodesia into the Belgian Congo at the Le Marinel hydroelectric plant. All of that was paid for in copper. What is also happening is that having left China to do long-term financing of infrastructure and development of mines. And since so much of new mine capacity is coming from, not from America and her allies, but elsewhere. So all of a sudden, it's happened literally in the last six months or so. Take DRC as an example. A new alliance has been established between the president of the country and America, that future mine projects, America is given first option. This was followed up by the DRC holding a seminar in Washington to promote the country's mining potential. That's phase one. The fear in China, who have big investments in the DRC, is that their operations might be taken over. So I think as we look around the world, particularly in South America, which Washington considers to be their backyard, we could see much more American government and private sector investment. So to answer your question, yes, this is on the forefront of Washington policy.
Yeah. This has been an incredible discussion. I want to welcome everyone who's tuning in to this fantastic interview with Simon Hunt, founder of Simon Hunt Strategic Services. And before we wrap up with our final set of questions, I just want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and you'll receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report that you will get. I'm positive that you've been enjoying the conversation that Simon and I have been having. Please let him know, hit the like and subscribe button, and leave a comment below the video. All right, Simon, we're going to finish off our discussion with an asset ranking lightning round. I mentioned this to you off camera earlier. I'm going to ask you to rank assets 1 to 100, 100 being an extreme buy, 1 being an extreme sell, and then just give 1 or 2 sentences as to why you take the position. We're going to roll through this as quickly as we can because it is a lightning round. Okay. All right. So on a scale of 1 to 100, is gold a buy or a sell, and why?
It is 100 buy, but short term, we could have a correction, so it's 20.
Okay. So short term, 20, long term, 100. And in your best guess, what's your time frame for short term?
Next 3 months.
Next 3 months. Okay. On a scale of 1 to 100, are the gold miners a buy or a sell, and why?
Same answer.
Same answer. So 20 or 100, same time frame.
Sure.
Okay. Physical silver, 1 to 100, and why?
Same as gold.
Okay. Then I'm assuming silver miners are the same.
Yes.
Okay. Let's move to copper, 1 to 100, and why?
That's a very difficult one.
This is your bread and butter.
Short term, next 6 months, 10. Longer term, it all depends on whether as I said in my introductory comments, that there is a risk, which is a 50-50 risk, that we don't have an inflation takeoff, that we have, starting in the middle of next year, we have a 2 to 5 year economic collapse. If we don't have that, then on a 2-year view, it's an 80% buy.
Okay. Let's move over to energy, and we'll start with uranium, 1 to 100.
I don't follow it.
Okay. Do you follow oil?
Yes.
Okay. What's your view on there? 1 to 100, is oil a buy or a sell, and why?
Short term, like the next 6 months, 20. Beyond 6 months, 80.
Okay. And do you have a reason for that?
Yes. Part of preparing for an attack on Iran, Trump does not want oil prices to escalate. So deals have been done that OPEC members, ex-Russia, are increasing production, and surpluses are therefore being built to cushion any short-term anyway shutdown of the Hormuz Straits because of an attack on Iran.
Okay. So post-attack is when you see oil starting to rise again.
Correct.
Okay. All right, let's move over to the general markets, the NASDAQ, 1 to 100, and why?
Next 3 months, 20. Next 2 years, 80, subject to there not being a war that creates financial turmoil.
Okay. And what about the S&P 500? Do you have the same
Same
viewpoint?
answer.
Same answer. Let's move over to treasuries, short-term and long-term treasuries, 1 to 100, and why?
I'll take 10-year treasuries as my guideline.
Okay.
Short-term yields down to 3%, starting mid next year, up to at least 8%, if not higher, by 2028.
Okay. Do you view short-term treasuries in terms of 2 years or less as a buy or a sell, 1 to 100?
By,
So you're up around 100 on the short-term treasuries?
yeah.
Okay. And is that because of optionality?
Sorry,
Is that because of optionality, or do you have another reason?
I think it's because the Treasury has to get yields down as part of their refinancing program.
Okay. And what about long-term treasuries, 10 years, 30
Well, I
years?
just answered that. I answered that one first.
Well, my question is, do you view it as a buy, though?
Short term only.
Short term only. So long term, you're staying away from the long-term treasuries.
So long term, we've got 2028 10-year treasuries at 10% plus.
Yeah. Okay. All right. On a scale of 1 to 10, with each representing a percentage, where do you see inflation ending around the first quarter of 2026? So over the next 6 months.
US inflation
U.S.
or
inflation.
global?
I'm sorry?
US or global?
U.S.
You mean the official CPI number?
Yeah. Yes.
That manipulated data.
So, we're around 3%. Do you see it coming down to 2? Do you see it elevated 3 to 4? Where do you see it?
Sticking around 2.5 to 3.
Okay. 1 to 10 probability, 10 being the highest. Are we headed into a recession by the end of 2026 first quarter? So over the next 6 months.
8.
8. Okay. A very high probability of recession.
Yes.
All right. So finally, the recommended portfolio allocations for decades has been 60-40, 60% stocks, 40% bonds. There's been no room for gold, precious metals allocations at all, related stocks, nothing. That seems to be changing a little bit. We've seen Morgan Stanley come out and talk about a 60-20-20 portfolio last week. Where are you on gold and gold-related ownership? Should people have a couple of percent, 10%, 20%?
50%.
50?
50.
And can you give just a concise answer as to why you take that position?
Because inflation is rising. The dollar will continue to fall. Look, a dollar in 1980 is now worth, I think, is 20 cents.
Okay. All right. Well, Simon, this has been a wonderful conversation. Would you please leave everyone with some takeaway that you want the viewers to keep in mind, and then let everybody know where they can learn more about your work and how they can connect with you?
The bottom line is think of security, not how much money I can make. How can I secure my wealth? And how can I food prices are going to soar. So always see that your deep freeze is full. And if you have a garden, convert part of it into a vegetable garden. And you can contact me on simon-hunt.com.
Wonderful. Simon, thank you for coming on to Metals and Miners again. You've been generous with your time and analysis and ideas, and I always love spending this time with you. I look forward to having you back on sometime soon. Everybody else, thanks for watching.
Thank you very much for having me.
And before we wrap up with our final set of questions, I just want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and you'll receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report that you will get.